Hey everyone, and welcome to Earnings Cheat Sheet for Friday, July 11th. It's Alexis, Garcia, and Ed Carson here, and we'll be taking a look at some key upcoming earnings reports to help you prepare for the week ahead. So, Ed, good to see you again, my friend. What's on tap for us today?
Yeah, it's nice to have earnings season come back in. Want to take a look at Taiwan Semiconductor, Netflix, and JPMorgan headlines, a whole bunch of banks.
Well, hopefully it's a hot earnings summer, Ed. And before we begin, I kind of want to just set some context for people here. Last earnings season was really dominated by tariff headlines. Can you paint a picture of where we are right now in terms of the market and news as we head into second quarter earnings?
Yeah, we had the tariffs, and also there was a lot of concerns about AI, and those AI concerns faded. The tariff concerns have faded to a great extent. Uh, Tariffs are coming back in the news, and I think it's still a question: are markets still expecting that there'll be some resolution, or have markets learned to accept, or like learn to accept and love the bomb, learn, kind of in a Doctor Strangelove kind of way. So those are still out there. Earnings season is always important, especially at the beginning of it, because we're getting that first take. We're going to hear from these companies. Well, how is AI spending? How are consumers and businesses in terms of lending and being able to repay things? All those things that get a tone, and so they'll have a big influence on the market because we might be getting tariffs impact, but we've been talking about that for a while. And honestly, we haven't seen a big impact in inflation yet. Have we seen a big impact in these things? So earnings season, especially as it ramps up at the end of the month, right when some tariff decisions come in, right when we get a bunch of economic data, there'll be a lot of interesting stuff. So again, a lot of uncertainty. This is why there's tons of news. This is why investors, yes, you should be aware of that, and you should be aware of all the companies reporting, and some of these major ones. But also, you just ultimately let the market tell you how to interpret these things, because rather than trying to say, I know what these tariffs, I know what these earnings will mean for this. It's just better to let the market tell you how to interpret the news.
All right. Well, now that we kind of have a lay of the land, let's get into some of these stocks, starting with JP Morgan, which is scheduled to release Q2 earnings on Tuesday, July 15th. And earnings for the banker are expected to fall 27% to 451 per share, and revenue is seen declining 14% to $43.849 billion. And here's why we're watching JP Morgan. Key factors to watch will be net interest income and investment banking fees, with those banking fees expected to decline broadly for banks. CEO Jamie Dimon's comments about consumers, investments, M&A also will be of interest, as long as tariff-related comments. And Ed, several analysts have raised their price targets on JP Morgan Chase ahead of earnings next week, kind of bringing a bullish vibe to bank earnings in the start of earnings season. So, what else is on your radar with JP Morgan?
Yeah, I mean, the banks have done pretty well here, and it's a positive sign about the economy, because they really are fairly cyclical in that regard. And it's like, companies are borrowing, consumers and companies are repaying their loans. That's pretty good news for that. Yield spreads have maybe widened out, so there's a lot of a positive backdrop. I think there are concerns that the economy is slowing and other things. So I think Jamie Dimon's comments about all these things. Well, how much investment banking is there? What is their signs? Are they seeing worrisome signs in the economy or not? Are they saying, things may be slowing down a little bit, which we know has been sort of happening, but is it that big of a deal? Are we seeing that? So I think some of that coverage uh, will be really interesting to see from JP Morgan, and from a lot of other banks, which will go over others. There's a whole bunch next week and then the following week that will really give a sign about how those big financials and are doing.
And the market has really remained resilient here, Ed. And let's jump over to the chart because we see JP Morgan here hit an all-time high on July 3rd, but has since pulled back, found support at this 21-day exponential moving average. So what are your thoughts here with the chart, and what would you like to see set up?
I mean, it seems extended right now, so I don't really know, because it broke out from a double bottom base, and then there was sort of a handle at around the 269 level that offered another opportunity to buy. Since then, it's sort of extended from those levels. So maybe if it pulled back gracefully or consolidated, let the 50-day, 10-week line catch up, form a new base. I don't really see a particularly good buying opportunity, but it's acting well. It's acting well. Uh, it is interesting to see that big earnings drop year over year. We're supposed to have modest earnings growth. I mean, I think a real question with bank stocks is that they have trouble outperforming for really long periods, and they've actually outperformed the S&P 500 for since the end of 2022, and that's with the AI revolution and all that stuff that generated things that these have still done pretty well. Can that continue if there's not going to be much in the way of profit growth in it? So I think that would be one of the real questions: is that can that outperformance really continue for much longer without faster growth?
All right, well, let's move on to Netflix, which is scheduled to report Q2 earnings on Thursday, July 17th. Earnings for the streamer are expected to rise 44% to 522 per share, and revenue is projected to climb 15% to $11.039 billion. And here's why we're watching Netflix. Earnings will likely key on international growth and comments about its strategy involving adding live channels, such as its recent deal in France that we just saw. And as we've seen over the last few years, it seems like a shift in strategy has really helped Netflix stock surge since 2022. We saw some cost cutting, the password sharing crackdown. They've launched this new ad supported tier and really ramping up those offerings. So, what are you focused on with Netflix ahead of earnings?
Yeah, I mean, it does seem like it just seems in general, it seems like the streaming price wars have, some of the pressure, everybody's raising prices. Netflix seems like something that you got to have. And even if you drop down to the ad tier, that's the thing. If you feel somehow desperate to drop to that, that's still pretty good for them. They're doing a lot of different things, and they're still expanding overseas. They're doing the live sports and other things. They're doing a lot of different activities, and it seems to be clicking. So it's just been really strong. I mean, we don't get the subscriber numbers anymore. So I think we're going to want to see what they have to say about it, there'll be a little bit of inference on that, and just talk about how about their cost controls, how is ad spending picking up for them, just a lot of some of those metrics. But we are really now fully fledged into the new era of Netflix, where you're just trying to rely on earnings and cash flow and some other things when we're looking at it.
And Ed, it was really interesting because I spoke to some analysts talking about this ad business and how important it is to Netflix's future growth. We saw reports earlier this year that they really have their eyes set on joining the $1 trillion club, and they were telling me it's still very early days. But we kind of see the streamer maybe not so much insulated from all the tariff news, but it doesn't really seem like people are trading down. It just seems like that ad tier is really giving consumers another option. So, any thoughts on how Netflix has been holding up amid all the kind of the back and forth going on in the market and with headlines?
Yeah, I mean, it's been very consistent. Again, once they got that flywheel where it seemed like they had enough growth and maybe reining in the cost, because there was concerns for a little while that there was actually in 2022, their profits fell. And so I was like, oh boy, is it just getting too expensive? But they found ways to control the costs, at least as a share of revenue. They've had all these things like the password sharing and the ad tier. So it just seems like they're finding new ways to expand growth. And it's a lot cheaper to license, say, old episodes of like Suits or Sex and the City than it is to generate brand new content and hope it becomes a hit, kind of thing. And because other streamers which were holding on to their content, that was a concern for Netflix. Oh no, we have to spend so much money. But again, this is stuff that's been going on for the past 2 years. It just feels like Netflix is just almost guaranteed at some point there'll be a point where it just can't grow anymore, that there'll be limits to that, or it'll become much slower growing. But that just isn't there yet. It's decelerating a little bit relative to the massive growth they had for a couple of years. But it's still going to be very strong growth, it seems like, through at least the end of next year.
All right, Ed. Well, let's jump over to the chart here because we saw Netflix break out of this double bottom base back here in April and extended from that entry. But if you bought into that entry, you hit a 20% profit taking level here. So give me your thoughts here with the chart with Netflix and how you would handle this ahead of earnings if you are holding this stock, and what would you like to see set up to get in?
Yeah, anybody who bought around that breakout, you can hold that. I mean, Netflix does have a tendency to make these big moves, and it could drop 10, 15%. So you could see your gains nearly wiped out. But I think a 20% cushion is a pretty decent sized cushion to go into that. And so because and to take care of that, if you bought really recently or added shares, you could consider like at 1262 or as it was moving off the 21-day line, you might consider selling those. I mean, that's just something, again, that's if you, especially if that's a big, if you added a lot of shares or something, but otherwise, I think you'd be waiting for, can it pull back to the 50-day or 10-week line, set up again, find a new buying opportunity because it's obviously pretty extended from that buy point.
All right, well, let's move on to Taiwan Semi, which reports earnings on Thursday, July 17th. The chip maker is expected to see Q2 earnings jump 60.5% to 236 per share. And on July 10th, the company reported Q2 sales of 30.17 billion, which is a 46% jump and slightly beating estimates of 20.78 billion. And here's why we're watching Taiwan Semi. We're still going to be very, very interested in AI server chip demand, as well as signs of any PC chip uptick. Guidance could also provide some hints on Apple iPhone 17 chip production expectations. And Ed, talking about this AI chip segment for Taiwan Semi, they do have a goal of reaching 90 billion in revenue by the end of the decade. So talk to me about Taiwan Semi and what you're looking at here.
Yeah, and Taiwan Semi, just to set the stage, they make chips for Apple, NVIDIA, AMD, Broadcom, and many others. And they're one of the biggest, if not the biggest, buyer of chip equipment. So what they have to say about on that will be a big deal. And how much guidance will they give? We knew that AI spending was strong this quarter. We knew it, and okay, and there's Q2 sales show that, and it shows that sales growth is accelerating. We have don't. It's not going to be in their report, but the 40 plus sales growth they had in Q2, showing strong acceleration. I think people probably be expecting a slight beat, at least on the earnings now, given those numbers. And that's powerful growth. Um, but will they give guidance beyond the next quarter? How much guidance? Or are they really bullish? And how much on the CapEx will they say? Will they be really think? So those would be signs, any signs like that AI is really strong, even ramping up, or is it maybe a little weakness coming ahead? I don't know, but that again, everything's going well, and weakness would be relative. It'd be weakness only like, given to the renewedly bullish expectations. Taiwan Semi is well over $1 trillion. NVIDIA is over 4 trillion or right at 4 trillion. So obviously expectations are high, but really important report because this really kicks off the entire chip and AI sector.
Well, Ed, expectations are high, and shares are also high in terms of being extended. We saw this breakout back in late May, but looks like Taiwan Semi really, again, extended above any sort of buy point here. But what are your thoughts with the technical action and what we would like to see set up heading into earnings?
I don't think there's anything to set up ahead of earnings. I mean, there was that buy point, then there may have been an alternate handle a little bit below 220 that it's sort of cleared, yeah, right around there that you might have done there. That would be a little trickier because the gap isn't as much, but certainly people who bought at the traditional buy point, big cushion, we'll see. I mean, it could, there's not really much to do. For people who don't have it, you sort of have to wait until it sets up again, whether a pullback to a key moving average like the 50-day line, or maybe sets up a new base. But right now, it's not slowing down.
All right, Ed. Well, those were some of the bigger names on our radar, but we have a lot more coming up to kick off this earnings season, a lot of financial names. So let's start with Citigroup, scheduled to report on July 15th. And another one here looking extended, Ed. So give me your thoughts on this chart.
Yeah, same kind of thing like JPMorgan. And it sort of had a couple of buying opportunities, and now it's extended. And this is a little bit more international. a little bit more money center than maybe or that, uh, but stronger growth expected for this year and next year. I think that was often a laggard. It didn't do well for 2 years. It had 3 years of declining earnings, and so now it's getting a bounce. So that this one might have it may be Citigroup's time to shine in that sense.
All right, well, let's look at Wells Fargo. They also post earnings on July 15th. And again, a common theme here, this one looking like maybe, again, extended from that 50-day line. But what are your thoughts here?
Yeah, it's a little extended. I mean, I suppose they could form a shelf because it's not crazy extended, maybe form a new buying opportunity, but that hasn't happened. It would need like after earnings, kind of situation. They did get their asset cap lifted by the Federal Reserve a few weeks ago after several years. It wasn't a shock but that's like from the fake account scandal from many years ago. Finally, all of that is lifted. And so that's a positive tailwind for growth perhaps in the next couple of years.
All right, how about Bank of America, which reports earnings on July 16th? Talk to me about this one.
Yeah, this one is actually pulled back. Maybe you could use the top of this base as a buying opportunity, even though it did have buy points, say around 45 and stuff. So while maybe extended. So there might be buying opportunities here. There's just a question. You're gonna have to look at these things and decide which ones are the better ones. This one, the relative strength line hasn't been as impressive here as it has been on some others. So do you want to go with one? That's again, when you get months into a rally, the stocks that are buying opportunities, often those are stocks that were a little bit of laggards.
All right, let's look at American Express. They post on July 18th. This one seems like it's just out of a buy zone here recently, Ed, but thoughts here?
Probably could treat that as an alternate kind of handler because it's near the top of the base. So yeah, this one's been doing fine. It looks about solid growth expected for the next couple of years. And yeah, so Dow Jones credit card giant, one of our Dow Jones credit card giants, but the one that's reporting next week.
All right, how about Goldman Sachs? They have earnings on July 16th. Thoughts here, Ed?
Yeah, so another Dow Jones giant along with JPMorgan and American Express. That one's a little stretched out like some of the other banks, and some solid growth expected this for the year. But yeah, seems extended right now.
All right, it seems like we're waiting on a lot of stocks to set up. How about BlackRock? They also post next week on July 15th. And this one, again, looking like it's a little bit, as you said, stretched.
Yeah, while it's not way above the top of that base, it's been running up quite a bit the last couple of weeks. And it's only 10%, but it's been going up quite a bit there. Seems like it needs to take a rest. Maybe if you had a few weeks to calm down, that'd be fine. I think the fact that the volume has dried up a little bit and part of that run, it really hasn't been a lot of massive volume, even though the stock has almost gone vertical. It's a little bit that would also be a reason to be careful about any kind of new buy.
Let's take a look at Charles Schwab. They report on July 18th. What are your thoughts here?
I mean, maybe technically it's right on the edge, or well, it's probably a little stretch even for there, like from around 90. There's sort of like that whole area. There's probably a little shelf, maybe, some kind of short consolidation there. We'll see. I mean, this one hasn't been as leading as maybe say Interactive Brokers or Robinhood in recent years, and so the growth has been slower. Net interest margins, again, with all these, and I forget this with banks, we talk about, but net interest margins, those are important for all the banks, but including Schwab, all the money they make on lending out to people going on margin.
Yeah, and you mentioned Interactive Brokers. That company also reports next week on July 17th. This one just out of a buy zone, Ed, but thoughts here on the technical action.
Yeah, nice technical action, just yeah, say a little extended, maybe if it pulled back, but if it that always becomes sort of like if it sells off hard, how much do you really want to be jumping into that? Otherwise, maybe it could form an alternate handle in the coming days or weeks.
All right, how about GE Aerospace? They post earnings on July 17th. And this one, again, Ed, looking a little bit extended from this buy point back here in May, but perhaps if you bought, time to take some profit, or how would you handle this?
I mean, you certainly could. The 20% profit taking zone, because a couple of reasons. It sometimes lines up with other sell rules because often it's like if a stock sort of gradually moves up, sometimes it lines up with earnings season. It just seems to like if there are more gradual movers, or so you could. Uh, that's one reason why you do the profit taking zone is because well maybe it'll sell off and tumble, or maybe it'll consolidate. That seems to be what it's doing. And do you want to wait that time? It sort of feels like if you held it through all this time, there's not really pressing need to sell either. I mean, you always could take partial profits. I think for folks, I mean, this could set up another base. It sort of has this sort of messy range it's in. Uh, it'd be great if the 10-week line, say, could catch up to this name, which is probably closer than the 50-day. See, the 10-week isn't far off, so that could provide maybe a buying opportunity. But this is important because this is GE. GE is like it's the first big aerospace name, a big supplier to Boeing. So this will be important even beyond GE for sure.
All right, let's wrap with a look at Travelers Insurance. They have earnings on July 17th. We're still on the weekly here, Ed. Looks like this one is basing with a 277.83 buy point, but looks like it's right testing this 40-week line. So what are your thoughts here?
Yeah, so the insurance had a nice run. There's came into trouble. This one had terrible earnings last quarter, but that's because of the Palisades and maybe some other situations, and everybody knew that. Supposed to bounce back a little bit in the latest quarter, but yeah, the insurers, many of them have come off. I mean, not some of them are still doing well, but many of them have come off. Would want to see it rebound, not just from the 40-week or in the 200-day line, but get above, maybe would be actionable above the 50-day line, which would be relatively close to the old buy point. There's that prior, see, it tried to break out and then it sort of fizzled out. So, there's be some, if it got above that point would be nice, but the relative strength line has definitely come off on this quite a bit in the last few weeks. So interesting to see if the insurers can turn around. But yet another Dow component.
All right, Ed. Well, that wraps it up for this episode of Earnings Cheat Sheet. If you want even more market analysis, be sure to tune in to Stock Market Today with Alyssa Coram. That goes live after the closing bell. And thank you so much for watching, and we'll see you back here next week.